So, Justin, I've been reading a lot of headlines, a lot in the news about this term, inverted yield curve. Now, what exactly does that mean?
Yeah, so we'll start by explaining what the yield curve is. So, the yield curve is a schedule of government bond rates. And I like to think about it, if you went into the bank and you were investing your money, they would, they might have you invest in CDs. Mm-hmm. And they would say, okay, here's the rate on the 1-year CD versus the 5-year. And you'd expect that you'd make more money locking your money up for 5 years than you would 1 year, right?
Yes.
You'd expect
because if I'm giving you my money for 1 year versus 5 years, well, the 4 additional years I expect to be compensated for giving you my money for the extra amount of years.
Right. Yep. And government bonds are the same way. They run in a lot longer duration than CDs. They go out 30 years. But same thing. You would say if I'm giving my government and investing for 3 months, I wouldn't expect to earn on my 3-month bond what I make on the 30-year.
Yeah.
Right?
Yep, makes sense.
So what we're seeing is an inversion. That would be a normal yield curve where you earn more later the longer you take money out. Mm-hmm. The inversion is you're now earning more on a 2-year bond than you are a 10-year bond.
So what you're saying is if I were to buy a 2-year government bond, I'm earning a higher interest rate than a 10-year bond.
That's right.
And that's backwards.
Yes.
So why is this
happening? Who would want to do that?
Yeah, who would want to do this, and why is this happening?
Yeah. So what's happening is I like to think of if you own a 10-year government bond, you could replicate that by owning 5 2-year bonds, right? You buy a 2-year bond, it matures, you buy another one. Yep. You can do that 5 times and you're 10 years from now, right? So what we're seeing is we're now in the largest expansion in U.S. history. And so this inverted yield curve is telling us that the expectation for future growth is now diminishing. And the markets are showing us that by saying people are buying these 10-year bonds at a lower rate than the 2-year because the expectation is if I bought, the 2-year, sounds confusing, but the 2-year 6 years from now is likely to be lower based on the Federal Reserve, who controls interest rates and sets interest rates in the economy, cutting rates, and that 2-year number going down.
Gotcha. So their expectation is I'm better off taking a lower 10-year rate today because my 2nd, 3rd, 4th, and 5th 2-year bonds are going to be at such a lower interest rate that you would have been better off buying the 10-year to start.
Exactly.
Okay.
That's what.
So is an inverted yield curve a bad thing? Because I've been reading some headlines, recession indicator flashes red, doom and gloom spreads. Yield curve flashes dire warning. I mean, the headlines are making it seem like a bad thing, but is it actually that bad of a thing?
Yeah, so the yield curve inverting is a leading indicator that can mean a recession is on the horizon. It's definitely not a great thing to happen. Now, there's a bunch of other indicators that we also look at. The yield curve inverting isn't the be-all, end-all. It doesn't absolutely guarantee we're headed for a recession. But it definitely increases the probability that, down the road we're going to see a recession. When we look at the numbers, this might mean on average we're 5 months from a recession, or the yield curve is also inverted and we never get the recession.
Yeah.
So it's like, great, we have this bit of information, but what you really draw from it
is difficult to nail down.
Yep.
So what should investors do? Do you sell everything and stuff your money in your mattress and wait it out, or do you ignore it and say, this is just a brief storm and nothing to change here?
Yeah. Well, probably somewhere in between. You don't, I guess if you're really conservative, you could sell everything, put it under your mattress, or you could buy a government bond, right?
Yep.
The problem with doing that is, well, if you use the mattress fund, right, you're just guaranteeing that you're not going to earn any money.
Yes.
And even if you buy safe investments, they're paying such low interest rates now that we see inflation, the price of goods and services, going up over time. And that's averaged a little over 2%. And with really low interest rates, if you're only getting 1.5% and the price of all the things you buy is going up by 2%, you're essentially losing money over time.
Yeah, so you're losing purchasing power to purchase the things that you need every day.
Right. So that's not, we don't recommend doing that. Ignoring it, though, that's not really the right answer either, because while we don't know when and if this recession is coming, we do know that there are certain types of companies that do better during these time periods. I think of, if you think of what you do on a daily basis, and if you woke up tomorrow and the reports told us that we're in recession, you'd probably still brush your teeth.
I will still do that.
You'd probably keep your cell phone. You'd probably still have internet. You'd probably still have all these things. Now, there's some discretionary stuff that you may not do. You might not go buy a new fancy car if the economy doesn't look so hot.
Or
you
I might not go on vacation somewhere to some destination that, I might do a staycation instead.
Yeah. So those types of things are what we call growth companies, and they've done really well over the last 5 to 10 years with the economy doing well. The opposite of growth is value. The value companies are the things you do every day. Those products that you consume on a daily basis, regardless of what the economy is doing. Those tend to do better than the growthier style investments in periods that we're getting into. So I would recommend, maybe moving some of that growth stuff to value, and also, taking a look at what your situation is and making sure that if it's money that you need to live off of over the next couple of years, making sure that that's safe and accounted for, and you're not depending on the stock market to make, to produce the income that you need. Because again, if you're invested in bond funds that are getting you 1.5%, while the stock market may see declines over the next couple of years, over a 10-year period, we still expect stocks to be, a really well-producing investment for people.
Great. Well, thanks, Justin, for talking about the inverted yield curve, and thanks for watching.
Thank you.